All right, let's dive right into this explainer because today we're unpacking a really fascinating case study, the financial engine of the Baldwin Insurance Group, or BWIN for short. If you're curious about the nuts and bolts of aggressive corporate growth and exactly how the market prices that kind of growth, well, you're in for a masterclass. We're going to use raw data straight from their Q1 2026 reports, look at Wall Street forecasts, and pull in some broader industry benchmarks to figure out exactly what is going on under the hood.
So here's our roadmap for today. First, we're looking at the bullish stock forecast. Then we'll check out the Q1 2026 financial snapshot. From there, we'll look at the cost of rapid growth, do an industry peer comparison, and finally wrap up with navigating market headwinds.
Okay, starting right off with Section 1, the bullish stock forecast and Wall Street consensus.
Before we even get to the analyst numbers, I want you to just hold this central question in the back of your mind. Is a 29% revenue jump actually enough to outrun a massive debt load? Keep that tension between top-line success and bottom-line reality front and center as we go through the data. Now check out this staggering metric, plus 101.2%. That is the highest analyst price target upside out there right now for B1. We've literally got a Wall Street analyst aiming for a $40 share price compared to a recent trading price of just around 19 bucks. I mean, that is a massive, massive vote of confidence in where this company is heading.
And when you look at the broader consensus, the optimism is everywhere. We're seeing 6 buy ratings, 4 holds, and absolutely 0 sells. 0. Even if we just look at the median target of $26, you're still looking at a nearly 31% upside. But here's the kicker, this bullishness is happening while the stock is actually down almost 50% over the past year. Clearly, Wall Street is treating this as a huge recovery play. So what exactly are they seeing?
Let's crack it open in Section 2, Q1 2026 financial snapshot, looking directly at the financial engine.
Okay, looking at the top line, it's undeniably strong. Revenue hit $532.2 million. That's a 29% jump year over year. Adjusted EBITDA looks super healthy too, up 21% to $137.2 million. But, and this is a big but, look at the bottom line. Despite pulling in over $500 million in revenue, they posted a strict GAAP net loss of $1.9 million. That is a pretty stark reversal from the almost $25 million profit they had in the exact same quarter last year.
To figure out what's really happening with the actual cash moving through the business, we have to look at BWIN's adjusted free cash flow. This is basically the money that's actually left over after accounting for all essential expenses and investments. For Q1, it was practically break even at negative $200,000. Why? Well, the company filings point the finger directly at heavy integration costs and some major acquisition activity that are just eating up the cash.
Which perfectly leads us into Section 3, the cost of rapid growth, uncovering those hidden expansion costs.
So, we've got this wild contrast here. On one side, adjusted EBITDA, which, remember, strips out certain costs, looks fantastic at over $137 million. On the other side, you've got that strict GAAP net loss of almost $2 million. This massive gap really highlights the impact of their M&A strategy. All those mergers and acquisitions come with a hefty price tag. We're talking integration expenses, severance packages, contingent earnout liabilities from buying other firms. That stuff is taking a massive bite out of the actual bottom line right now.
And honestly, this right here might be the most revealing metric we look at today. While total revenue is surging by 29%, their organic growth, meaning the growth of the core business, completely stripping out the boost from those new acquisitions, has actually slowed down dramatically. It dropped from 10% in Q1 of last year to a mere 2% this year. Essentially, BWIN is buying its revenue growth right now, rather than generating it organically.
Of course, going on a buying spree requires a ton of capital. And that brings us to a debt-to-equity ratio of 158.4x. Yeah, that high leverage is definitely a sobering reality check. They've taken on a massive debt load to fuel this M&A engine. Now, to be fair, they aren't totally out of runway. They do maintain $146 million in cash equivalents, and they still have $393 million in borrowing capacity. So they've got a buffer. But make no mistake, that debt weight is extremely heavy.
All right, let's zoom out and ground our analysis in Section 4, industry peer comparison and the broader landscape.
To keep things totally objective, we're going to pull in some independent industry data from Mercer Capital's first quarter report. This snapshot is going to give us a really vital benchmark, so we can evaluate BWIN's valuation and performance directly against its peers in the insurance broker space. When we extract the key numbers and compare BWIN to the group median, a really fascinating picture emerges.
BWIN is currently trading at a premium valuation multiple, an EV to EBITDA ratio of 24.2x, while the median is sitting way down at 14.7x. The market is literally paying a premium for BWIN. But here's the catch. Their trailing revenue growth of 8.3% is actually lagging the median's 13.3%, and their EBITDA margin is nearly half the median at just 14.2%. So what does that mean? It means investors are betting incredibly heavily on BWIN's future ability to scale up and realize synergies down the line, rather than looking at their current margins.
Finally, let's look at Section 5, Navigating Market Headwinds and the Macroeconomic Factors.
Because they don't operate in a vacuum, right? BWIN's own Q1 Market Pulse report shows us a real mixed bag of external pressures. The broader insurance market is still highly fragmented, which absolutely justifies their aggressive M&A strategy. But we are seeing some significant divergence in pricing. Commercial property pricing is actually softening right now, hitting a recent low. Meanwhile, the pressure in casualty lines is persisting. One bright spot, though, is the D&O, or Directors and Officers Insurance market. That's stabilizing, with 54% of companies reporting stable premiums year over year.
This industry analysis really hits the nail on the head regarding BWIN's core challenge. Lenders and analysts are laser-focused on whether or not BWIN can actually deliver on the synergies they've promised from all these buyouts. Can they expand those margins and get back to consistently positive free cash flow to justify that huge debt load? If this current favorable pricing environment in certain commercial lines starts to cool off, BWIN's operational efficiency is going to be severely tested.
So I want to leave you with this final thought experiment to ponder as you evaluate BWIN's underlying health. Can their aggressive M&A growth outpace the sheer weight of that high leverage? Or will the crushing integration costs end up dragging down those lofty Wall Street targets? It really is the classic battle between top-line expansion and bottom-line reality. Thanks so much for joining me to unpack all this today. Keep crunching those numbers, and I'll catch you in the next explainer.